All right, hey, my friends, welcome back to Premier State Investing. Great to have you. Well, today, stocks have been a little bit off, have they not? So I thought it would be an appropriate time since I saw this coming from Ray Dalio. Are we in a stock market bubble? He asked quite simply. We've seen him, of course, a lot on YouTube and different media outlets talking about his research that they just call principled perspectives. Sometimes just it looks like principles here. But we know that he's gone back 500 years. He's talked about a lot, the different debt cycles, the different market cycles. We've also heard Ray talk about the dollar being the global reserve currency and that could change, that it has changed in the past and it will certainly change at some point in the future. Well, I just thought I'd dive into this. He is on LinkedIn, if you're not on LinkedIn, but I want to draw your attention. This is very recent. This is February 22nd. Today is the 23rd, so this is less than 24 hours old. Here's what he has to say, and he's going to give us a little table, a little indicator, telling us what he thinks about the current situation, bubble or not. I've seen a lot of bubbles in my time, he says, as I've studied even more in history, so I know what I mean by a bubble, and I systematize it into a bubble indicator that I monitor to help give me perspective on each market. We now use it to look at most markets we are in. I want to show you how it works and what it is now showing for U.S. stocks. What I mean by a bubble is an unsustainably high price, and how I measure it is with the following 6 measures. Measure 1. How high are prices relative to traditional measures? 2. Are prices discounting unsustainable conditions? Number 3. How many new buyers, i.e. those who weren't previously in the market, have entered the market? Number 4. How broadly bullish is sentiment? Number 5. Are purchases being financed by high leverage? And number 6. Have buyers made exceptionally extended forward purchases, for example, built inventory or contracted forward purchases, etc., to speculate or protect themselves against future price gains? He says each of these 6 influences is measured using a number of stats that are combined into gauges. In the stock market, we do it for each stock that we are looking at. These gauges are combined into aggregate indices by security and then for the market as a whole. The table below shows the current reading of each of these gauges for U.S. equity market as a whole, and the chart below it shows the aggregate reading derived by combining these gauges into one reading for the stock market going back to 1910. It shows how the conditions stack up today for U.S. equities in relation to past times. So here's the 6 that we just read. Where do you guys want to start? You want to start? Let's start in the roaring 20s. Bubble all the way across, except for the bottom one. Sorry, I'm going to have to move this around a little bit just so we can read it. It says it was frothy, which I guess is less than bubble. .com bubble, bubble all the way. 2007, it said no bubble for prices that were high relative to traditional measures, and neither were they predicting bubble for prices are discounting unsustainable conditions. Anyways, they give us today for the total market, and they also do something for the emerging tech market. So this is interesting. 3 bubbles out of 6, 2 frothies, and a somewhat frothy for emerging tech. I think this is interesting. If you saw some of the Double Line did a 3-part series with DiMartino Booth, also James Bianco, and that guy. He's like the Bond King. I'm not remembering his name. But anyway, they were all suggesting getting into value and emerging. We also saw that coming out of the article that we just did from Jeremy Grantham. So he also thought value and emerging were good things, but maybe stay away from emerging tech. Anyways, the total market, you can see, somewhat frothy, no bubble on the second point. Let's see if I can move this over just, yes. So for the first point, somewhat frothy, second point, no bubble, third, fourth, frothy, fifth, somewhat frothy, and sixth, no bubble. So he goes on. He says in brief, the aggregate bubble gauge is around the 77th percentile today for the U.S. stock market overall. In the bubble of 2000 and the bubble of 1929, this aggregate gauge had the 100 percentile read. So that's kind of where they based everything off those really bad crashes. And so he says we're at the 77th percentile, about here. About here. So we've seen a lot of thumbnails. We've seen all kinds of people say we're getting ready to redo the year 2000. Well, Ray says not exactly. And so that might be something interesting in comparison to other writers, other thinkers, other investment managers that are out there. A lot of people respect Ray, and his hedge fund is really based on macroeconomic approaches. So you can read more about them. They're Bridgewater Associates. He is the founder, and he's now like a co-investment chief. And what else do we have here? There's a very big divergence in the reading across stocks. Some stocks are by these measures in extreme bubbles, particularly emerging technology companies, while some stocks are not in bubbles. The chart below shows the share of U.S. companies that the measure indicate being in a bubble. This is about 5% of the top 1,000 companies in the United States, which is about half of what we saw at the peak of the tech bubble. He's referring to 2000. So the number is smaller for the S&P 500 as several of the most bubbly companies are not part of that index. So here we have the top 1,000 companies. Here we have the S&P 500. This will give us, what is the aggregate size of bubble companies remains about half of the tech bubble. So that's a comment. We'll see the same percentage here, 0 to 12%. And the top 1,000 companies look like they're 11.5% in 2000. Today they're at about, what we'll call this, 5%. If we are investing just in the S&P 500, he says that gets rid of some of those bubbly companies. In 2000, it was about, what is that, a little bit over 10, and now we're at about 3%. So these graphs tell us that we're in a very different environment, which is helpful to know if we have other things to do besides compile data, economic data, over the last 20 years. Yeah, many of us have other jobs and stuff. So we took stocks that are in the bubbles and created a basket of quote-unquote bubble stocks to keep a close eye on them. The chart below shows their performance and the performance of our basket of the top 500 companies. The market action is reminiscent of the Nifty 50 in the early 1970s and the dot-com bubble stocks in the late 1990s, both of which I remember well. It scores similarly to the bubble stocks of the late 1920s, which I can't remember because I wasn't alive then. So what we have is the returns since the start of 2020. This is the top 500 in blue and the bubble companies in red. So the top 500 have had, I don't know, what is this, a 23% return, I suppose, while these bubbly companies, 350%. So something to think about. He says, well, I don't show you exactly how this indicator is constructed because that's proprietary. I'd like you to learn more. You can see some of the sub-aggregate readings in some of the indicators here. If you click on the link, so if we click on this link, it takes us over to bridgewater.com. They tell us before we go in that the content constitutes the proprietary intellectual property of Bridgewater or its licensors, and that I will not directly or indirectly copy, modify, recast, create derivative works, post, publish, display, redistribute, disclose, or make available the content in whole or part to any third parties, or assist others to do the same, or likewise make any commercial use of the content without the prior written consent of Bridgewater. Well, this is as far as I go, but you're only one click away from seeing the sector-by-sector breakdown. So you can go to Bridgewater. It looks like it's under Research and Insights, and then you're looking for Ray Dalio Stock Market Bubble. I'll leave the link in the description. Thanks so much for stopping by. Best to everyone out there.